Should you stop buying stocks and buy bonds instead? That's what some analysts now believe, and it's because something called the earnings yield on stocks has fallen such that it's roughly equal to the yield on short-term US Treasuries. So in this video, we'll dig into what we mean by earnings yield and what the implications are for investing and some of the evidence which has led to that quite surprising claim. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. So let's look at stocks versus bonds and whether you should stop buying stocks and buy bonds instead in a bit more detail. Now, this is the graph that's got everyone talking, and I'll unpack it as we go through the video. But really all it's doing is comparing three different yields. The first one is the earnings yield on US stocks, which is at 5.3% currently. The second one is the yield on US Treasuries with 3 months left to run. So that's a very short-term US Treasury. And then the third thing is US investment grade corporate bonds. These are loans to very high credit quality US companies. But what's truly remarkable is that the three yields are currently roughly equal, 5.3%. That's very unusual historically. And as you can see here, there's a quote from Luca Paolini, who's the chief strategist at Pictet Asset Management. And what he's saying is that if you're a US investor, you should probably buy bonds because in risk-adjusted terms, they're going to give you more. Risk-adjusted just means you look at the return and you divide by the volatility. Now, one comparison there is not particularly controversial. If you look at US single A credit quality bonds, these are loans to single A rated US companies. This is roughly equal to the yield right now on those 3-month US Treasuries. Now, given the choice between the two, you'd clearly favor US 3-month Treasuries because you're taking almost no duration risk. You're not locking in a rate for a long period of time. There'd be very low volatility investments, and you've got almost no credit risk at all. Whereas with the corporate bonds, you would be facing a little bit of credit risk. So for these two, it's pretty clear. You'd go for the Treasuries. What's not so clear is the comparison with equities, as we'll see. So why is the earnings yield looking so low in the United States right now? What is earnings yield? Well, it's just the price to earnings multiple flipped upside down. So instead of looking at the price divided by the forecast earnings, it's the forecast earnings divided by the price, expressed as a percentage. So when stocks are expensive, price to earnings goes up and the earnings yield goes down. And what's happened is that it's fallen to meet those rising US Treasury rates as the Fed's been raising them. So if we look at US valuations right now, you can see that yes, they are quite elevated. The S&P is roughly at its 5-year average price to earnings multiple based on forecast earnings of about $230 over the next year. So lower earnings yield is just another way of saying that US stocks are expensive. Now, if we look at the Simba spreadsheet, this is produced by Bogleheads, the forum, you can actually see going back 150 years what the annual returns have been for a total US bond fund and a total US stock fund. Now, what's truly remarkable about 2022 was the size of the fall in bonds. There's never been a year when the size of that fall has been greater. So that 19% fall that you can see is in real terms, it's inflation adjusted, and it's a total return. If we compare that with a fall in stocks in 2022, which was sizable, about 25%, you can see that there are actually many years when the fall in stocks has been greater in the United States. So what wasn't a particularly exceptional fall in the US stock market was truly phenomenal in the bond market. So why on earth are we talking about buying bonds after that catastrophe? Well, if you have bonds falling in price, a magical thing happens, which is that their yields increase. In other words, the return that you receive for buying a bond now after this crash is going to be much higher. To a certain extent, the same is true for equity. Once prices fall, usually that increases the long-term return. But for bonds, you can actually quantify it. You know what the return is going to be if you buy a bond today and hold it to maturity. So the reason why equities are now less attractive is because of the huge rally, and the reason why bonds are attractive is because of the crash. and the fact that yields are now so much higher. Now, if you want to keep track of the value of the S&P 500 using the forward PE, but also other measures and the value of other asset types, and get access to all sorts of other goodies like members-only videos, you can do that with our premium online membership on our website. To learn more about that, just go to our website, PensionCraft.com. Before we go on, let's quickly dig into what we mean by yield, because those three yields that we talked about aren't exactly the same. So the 3-month Treasury yield is very simple. It's just how much you'd make if you bought a 3-month Treasury and held it to maturity in 3 months' time, annualized. For an investment grade US bond, and here I'm talking about single A credit, then again, you just hold the bond to maturity and the yield is how much you'd make between the time you buy and the time that you have the bond mature. Now, the third one is a bit more problematic because you don't really know what return you're going to get on the S&P 500 over any period of time. And that's because the earnings are unknown, the price is very volatile, and there's no fixed maturity date for equity. So although we can calculate a yield for US stocks, it isn't really a comparable thing. It's like comparing apples and oranges. So what does the outlook for bonds look like right now? Well, Vanguard produces a 10-year outlook, and if you look in sterling terms, here's a comparison of the different types of bond and what Vanguard thinks they're going to be returning over the next 10 years. And these are nominal returns. They're not inflation adjusted, but they are total returns. So for EM sovereign bonds, there's a pretty chunky 7.2% return year by year expected. And that's because you're taking credit risk there. Also, there was quite a big sell-off in those sovereign bonds during the pandemic period. If we look elsewhere across different types of bonds, well, government bonds aren't so yieldy. UK government bonds are only expected to return 4.3% over the coming decade. As we'll see, those yields have gone up since this forecast was created. But what's interesting at the moment in the fixed income space amongst bonds is you don't have to take a lot of risk to generate a pretty decent return. For example, even if you look at the cash rate, you can see that the return is 4.2% when we do this comparison. Now, bonds are more complicated than stocks because they have an extra dimension, which is the term of the lending. So if we lend to the UK government or the US government, these bonds come with a maturity date, which can be anywhere between 1 month and 30 years or even further. And the different rates that you get depend on how long you're lending to the government. So in the top panel here, you can see the yield curve, as it's called, for different periods of lending to Uncle Sam. And in the bottom panel, you can see the same thing for the UK government. What's unusual about the shape of these curves is that they're inverted. In other words, short-term lending, which comes with very little risk, these prices of these bonds tend to be almost a flat line. These are the ones which are giving you the highest returns. So you're being paid to take very little risk by these governments. So in the US, if you lend to the government for 6 months, you'll earn about 5.4% currently, and in the UK, 5.3%. So you can either do this directly by buying single bonds, and I've done a video about that if you're interested, and also a longer video for our members, or you can buy a bond fund, which has very short maturity, or even better, a money market fund, which is ultra short maturity. You're taking almost no duration risk, very little credit risk, but still earning a reasonable rate of return right now. Now in the US, Vanguard has updated its model, its forecast model for the coming decade. And again, these are nominal returns, not real. They're not inflation adjusted. In fact, you can see the expected rate of inflation over the coming decade, and that's 2.5% according to Vanguard in the US. But what I've done is color code the bars so that blue is stocks and red is bonds. So the 3 highest returning forecasts are all for stock funds. So if we look at global stocks, excluding the US, unhedged, so this is in dollar terms, those should return about 7.4% per year over the coming decade. Emerging markets are comparable, as are ex-US developed markets. All of those are currently forecast to yield over 7% per year. In order to achieve a comparable return for fixed income bonds, you'd have to take quite a lot of risk in one form or another. One would be emerging market risk, Again, sovereigns in emerging markets are quite risky. They often default. High yield is another option. There you can see that the return on high yield US corporate bonds, these are the lowest credit quality companies, that should return around 6% over the next decade. But if we look at investment grade or treasury funds in the United States, those will only return about 4.1 or 4.7%. Now, one of the reasons why it was so shocking to say buy bonds rather than stocks is that if you look at the long-term returns of bonds or stocks in the United States over this 150-year period, bonds have only returned 2.4% in real terms, whereas stocks have returned 6.7%. So a 4% increase, over 4% over that period on average every year. So certainly when strategists talk about buying bonds, they're not saying hold bonds for the long term. Far from it, that will not work. What they're saying is this is a tactical play. So here we're talking about an asset allocation shift of say 1 year, 2 years, at most 3 years, I'd say. So let's come back to the stock returns and why analysts expect them to be low. If I had to characterize the period since 2020 in terms of animals, well, I'd say that we had a huge bull market following the pandemic sell-off. So that's the big bull you can see here, when stocks rose by over 100%. Then we had a little bear, not a particularly big one, 25% is not huge for the S&P by any means. And then we had a mini bull, which was a recovery period that we've seen over the course of the last 6 months or so. So stocks have risen about 23%, but of course that's not enough to make up for the 25% fall with the way percentages work. You have to rise a lot more than you fall to get back to where you started. But still, that's a pretty chunky rally on no new fundamental data. In fact, earnings haven't been very strong, as we'll see. However, I think the cause of the euphoria this time around is very much to do with artificial intelligence. And frankly, I don't believe it. Do you get what I did there? AI? I don't believe it. Okay. And in fact, there's a great tweet by Sean Tuffy who actually talks about all the different forms of euphoria that we've seen since the pandemic and before. So he's got it in the form of a Scooby-Doo unmasking. You know, I'm a big fan of Scooby-Doo. Starting with the PayPal mafia, then we got the fintech grifters, then we got self-driving cars, crypto, Web3, and then finally we've now got AI grifters. It just seems as if every single one of these stages of euphoria triggers another rally in the US market. Now, during a period when interest rates are zero, I can kind of believe in those. But when interest rates are much higher as they are now, you've got to back up that euphoria with some hard earnings. So let's look at the earnings for the S&P 500. Now, what you can see here is the year-on-year increase quarter by quarter. The blue bars are the historic earnings, and the red bars are the forecast earnings growth based on analyst forecasts. Notice that we've already had 1 quarter of falling earnings. So Q4 of 2022, we saw earnings fall by over 3% year on year. We're currently getting Q1 2023 earnings, which are also expected to be negative. So again, minus 1.7%. And then in Q2, what's expected is we're going to get over a 6% year on year fall. So this is an earnings recession. Normally what happens when there's an earnings recession is that stocks plummet. Clearly, that's not happening. Stocks are rallying on the basis of euphoria about AI. It's as if they can completely ignore fundamentals, which is always true for a while, but never true for long. And certainly the stocks which are dragging the S&P upwards have been very profitable. So if you look at the contribution to the total profits of the S&P 500, Meta, Nvidia, Alphabet and Amazon are doing more than their fair share of heavy lifting. So if we just focus on 3 of those companies, Amazon, Meta and Nvidia, they're expected to report year-on-year earnings growth for Q4 of 2023 of over 100%. And if we look at the Q4 2023 aggregate earnings growth year-on-year for the S&P 500 is expected to be 8.2%, which is considerable. However, if we strip out those 4 companies, it would fall to just 4.2%. So at least some of the mega cap euphoria is fundamentally based. And you've probably seen breakdowns like this, which look at the year-to-date rally in the S&P and break it down according to the mega-cap tech stocks versus the rest of the S&P 500. And essentially, the mega-caps are doing all the heavy lifting. The contributions from the rest of the S&P, when you weight it according to market cap, is essentially flat. So what can we say about the return on the S&P 500 based on these valuation measures? Well, I think one of the best measures to look at is Robert Shiller's excess CAPE yield. In order to generate this number, what he does is he takes the price to earnings multiple, the CAPE multiple as he calls it, this is the cyclically adjusted price to earnings multiple, and he turns it upside down, just as we did for the earnings yield at the beginning of this video. But then he does something else, which is to adjust for real return on 10-year US Treasuries. The idea here, the intuition, is that when interest rates are really low in real terms, people are willing to pay more for stocks. That's the euphoria we saw for the last decade. But once real interest rates start to increase, as they have done recently, then people aren't willing to pay so much. So by adjusting for real interest rates, he comes up with a kind of euphoria measure for US stocks. And when there's lots of euphoria, as we can see, there's usually less return. So the excess CAPE yield on this graph is at the bottom on the x-axis, and when stocks are really cheap, we're at the far right-hand side of the graph. And when stocks are expensive, we're on the far left. Then what we do is we track the S&P 500's returns over the next decade from each starting point of valuation. And what you can see is that if you buy stocks when they're cheap, you usually get higher returns. It's a very intuitive result. Currently where we are is the vertical red line. And you can see that currently we're pretty expensive. And usually when it's expensive, the S&P returns less over the following decade. But the key point here is that there's a lot of uncertainty in that estimate. Sometimes when stocks are expensive, they still have pretty good returns over the next decade. So this is why I wouldn't take these forecasts based on earnings yield, whether it's from Robert Shiller or strategists elsewhere, too seriously. So what can we conclude from the fact that earnings yields are now low and Treasury yields at the short end of the curve are now high and comparable? Well, I think an incorrect conclusion is that you should rush out and sell all your stocks and buy bonds instead. That would be crazy. Another incorrect conclusion would be that bonds are going to outperform stocks over the long term. Usually they underperform by around 4% per year. A correct conclusion would be that the short end of the curve is now a very attractive place to park your capital short term. So if there is a choppy patch for stocks, then yes, buying short-dated government bonds might be able to fill that gap with a safe investment. Also, if you are going to invest at the short end of the curve, you can do that with single government bonds, and I've made a video all about that. Now, don't forget our offer. If you do want to join our community and learn more about investing in bonds, money market funds and stocks, and how valuation matters, but also have access to all of our goodies and our membership tools, just go to our website, PensionCraft.com. And, as always, thank you for listening.